It's important. Well, passive as an investment strategy, as a proportion of money in the market, overtook active in US long-term funds in 23-24, and at the end of 2024, it represented approximately 53% of the volume in the US market. As passive ownership has risen over the last 30 years, so too has the market become more inefficient to the point where now it is 25% less efficient than it was 30 years ago. I think this is going to be the best time to be an active investor in history.
Teaminvest is an exclusive investment community with over 600 members across Australia and New Zealand. We use our proprietary software and the wisdom of the crowd to analyse companies like business owners, not speculators, to identify wealth winners and avoid capital killers. Our members expect an annual return of a minimum of 15 to 20%, with many of them achieving much more over the 18 years we have been running. At Teaminvest, we're about transferring our knowledge to the next generation of investors. Whether you have been raised with an awareness of investing or whether the family legacy begins with you, our goal is to educate and equip you with the knowledge and tools to build generational wealth. This week, we're going to cross over to a webinar that was run by our CEO, Andrew Coleman. The webinar's titled When Market Stops Thinking, Passive Investing, Superannuation and AI's Impact on Your Wealth. Hope you enjoy.
What I want to talk about today is two very large themes in investing that I think are becoming more and more prevalent, certainly more and more prevalent in the media, if not in our markets. And those are firstly, passive investing, the idea of index tracking and the following of rote-based or quantitative-based systems. And then secondly, the rise of AI, and the rise of AI in particular in our case in relation to investing in the stock market. I mean, there are many more people who are more qualified to talk about AI as a business tool or AI as a solver of questions and as a large language model or machine learning tool. But I think what we really want to focus on today is how is AI impacting the market and what does that mean for our wealth? Now, for those of you who are already Teaminvest members, you will have seen a version of this talk a few weeks ago. It was due to the reception to that talk that we've decided to open up this version of it to the general public. So obviously, if you've seen these things, some of these items before, they will have slight tweaks. I've updated a few of the slides, but overall the themes are similar. And if you're new, by all means, welcome to the journey with us. So really, we're going to talk about those two big themes of passive investing and AI and algorithms, and in particular in relation to Australia's what I refer to as Australian exceptionalism, which is that idea of those themes mixing in with some of the regulation in the Australian market, in particular the My Super legislation, Your Future, Your Super, and the Hayne Royal Commission. And then what I'm going to do after I've hopefully explained those concepts and you're all following me and we're all getting our brains churning on what that means, I'm going to throw up what I think or why I think these things matter, which is firstly a version of the Grossman-Stiglitz paradox, and then my own hypotheses. And then I'm going to ask the question that I think is most relevant to all of us, which is how can we, as investors in the market, considered, researched, rigorous investors, conscious investors in the market, how can we benefit? And of course, hopefully, leave you with some really valuable tools that you can use to go away and turbocharge your wealth creation. And also, importantly, avoiding wealth destruction. So let's look at the big global themes to start. So the first global theme I want to talk about today is the rise of passive investing. And really, what we mean by passive investing is investing defined as investing by mimicking a published index. So you all obviously know about the ASX 100, 200, the S&P 500, the NASDAQ indexes. Effectively, there are ways out there now, and it's becoming a larger and larger proportion of the market, to get a return that follows simply that index. And they're done in one of two ways. They're either done by being what are referred to as long passive index, in other words, a bundle of stocks that exactly matches the index, or a synthetic index. In other words, effectively a manager says, I will offer you the same return as the index and matches that through a use of a number of derivatives. How they do it doesn't really matter for today, though we can certainly answer that in Q&A. What we really want to talk about, though, is what passive investing is and why it's rising so much. And why it's rising so much is that lovely saying, which industry super funds in Australia have used so much, which is that 80% of active investors fail to outperform the market after fees. And that's been an incredibly successful marketing campaign, of course. The challenge is one should always ask the inverse of any question, which is what percentage of passive indexes have ever beaten the index after fees? And of course, whilst only 20% of active managers do, a grand total of 0 passive managers can, because a passive manager is by definition holding the index and charging you a fee, perhaps a low fee, but a fee all the same for doing that. So it's effectively a guaranteed way of underperforming the index, but that might be better than the risk you take in active management. Well, why is this important? Well, passive as an investment strategy, as a proportion of money in the market, overtook active in US long-term funds in 23-24, and at the end of 2024, it represented approximately 53% of the volume in the US market. That number has probably grown since. In Australia, it's also been estimated that passive funds now own more than half of the ASX 200. And the reality is probably even higher once you include superannuation and index-aware products, and I'll talk about what that means later. But simply an index-aware product is one that mimics an index but has minor deviations. So for example, it holds the ASX 200 except one or two things or a specific sector that might be considered problematic. And in fact, if you look at the ASX 20, the 20 largest companies in Australia, over 27% of the entire ASX banking sector is now owned by superannuation funds. And of course, as superannuation balances rise, monies flow into the index in proportion to those market caps if they are passive or index aware. And I've got a graph up on the top right-hand side because I just think it's important sometimes to visually see this change. This is the number of new mandates appointed by not-for-profit funds and investment managers, the big users of investment management services in Australia, to active managers over time. And as you can see, between sort of 2018 and 2012, which was pretty standard, there was between 1,500 and 2,000 new mandates a year awarded to active managers. Today, there's less than 200. And from that point of view, you have to ask the question, is that going to be constantly a theme? And at what point is that theme going to create challenges for the market and opportunities for active investors? So the next big thing I want to talk about after that is AI and algorithms. So when we talk about algorithms, I just mean quantitative investing, which is the use of a mathematical model to invest or trade. And AI, of course, despite it being de rigueur and sexy right now, is just simply a form of quantitative investing. It's a way of allowing more data to be processed faster and now include languages as well as numbers. So that means they can look at things like earnings reports, earnings calls, news articles, Twitter posts, not only numbers, where of course 10, 15 years ago, a quant model was only able to look at published information that was in numerical form, things like balance sheets and profit and loss statements. What I do want to highlight, though, is that quant isn't new. In fact, our conscious investor software that we use here at Teaminvest is actually a form of quantitative investing. It's a quant model, and it was originally developed in 2001. What it's doing, of course, is looking at the index in any country and excluding all those items in it, all those companies that we think show one or more signs of being a potential dog. And that way, of course, we hope to beat the market long term. But effectively, all quant does is look at data to determine an investing strategy. And all AI is doing is looking at more data faster. And of course, adherents who believe that AI is going to be particularly valuable in the financial services sector believe so because they believe that AI can identify market sentiment and momentum faster than a human. And they're probably right to some extent. I mean, there is no doubt that AI can process data faster than you or I can. Number one, it works 24/7. It doesn't need to eat or sleep. But number two, also, it ends up with enough money and enough chips behind it, being able to do what one brain can't. The challenge, of course, only comes down to the simple question, which is, does that give you an edge? And if you believe that processing data faster is an edge, it means effectively that you must believe that either markets are efficient, which means speed is more valuable than insight, or that gains can be made by riding trends up and down. Things like sentiment, index inclusion, macroeconomics, politics, being able to pick the trend first and get ahead of it creates value. That's effectively what AI and any form of quantitative investing that relies upon speed is looking for. It's looking for the ability to be able to identify something faster and then act on it than a poor human could. And if you want to sort of use an analogy for that, it's the equivalent to the idea of T20 compared to Test cricket. Speed, power, and momentum, T20, quantitative algorithmic AI investing, versus thought, tactics, and strategy, Test cricket. Sitting down and understanding a business, understanding what an asset's doing, if it's property, if it's fixed income, if it's a bond, whatever it is, right? And so the question we should be asking ourselves as investors when we're thinking about what is it going to do to the market is not only what is it doing, but how prevalent is it? Because there's no point investing a whole bunch of time to understand what something is doing if it represents a tiny fraction of the market. And I've got a quote here from the AFR only last month, which was from Martin Conlon, who is head of Australian equities at Schroders, which is, of course, one of the largest equity fund managers in the world, saying that fundamental investors like us are no longer price setters. Most of the market money is flowing to quant and earnings momentum type strategies, and perversely, investors then assimilate that behaviour. In other words, the computer is setting the prices and human investors are chasing them in. In other words, the computer is acting first, and at this point in time, it's creating effectively a self-fulfilling prophecy. The computer is deciding something. Share price is going to go up based on some news or information. The share price rises, and that forces investors who would like to get a return to buy, to benefit from that rise, or vice versa. The computer decides something's going to fall, the algorithm decides it's going to drop, and investors are chasing that down afterwards, which is a pretty bleak assessment if you think speed matters in investing. So with those two big themes, I want to talk about how Australia is uniquely positioned because of passive investing in AI. And it really requires me to do a little bit of a boring, nerdy sort of summary of some of the regulation that's in the Australian market, but I hope you'll bear with me and I hope you'll see where I'm going with this. So the first bit of legislation I want to talk about is the MySuper legislation that came out in 2012 under the Gillard government. And under MySuper, all trustee-directed superannuation funds were required to offer a fixed, low-fee, index-aware option. And those are the words I want to focus on. Fixed, low-fee, and index-aware. And moreover, this fixed low-fee index-aware option was required to be the default option for all new scheme members. So when an 18-year-old starts at work and they join their first cafe or wherever it is they're working, they would be automatically put in to the fixed low-fee index-aware MySuper option. And the logic behind it was relatively sound. I mean, I can't blame the Gillard government for this. The logic is simply that the average person doesn't have the capacity to understand what is a good or bad investment. As such, the biggest predictor of their long-term wealth is going to be reducing fees rather than letting them speculate on making more money. It's a very logical, sound approach. And MySuper had two key effects, of course. Firstly, it changed superannuation trust. Let me try again. It changed superannuation trustees' focus from net returns, in other words, how much does the investor make by using them, to fees. Or low, another way you could put it is that low fees became more important than performance after fee. So if it doesn't matter how poor my performance was, as long as my cost was down, rather than what matters is the net performance. And secondly, by doing so, it therefore removed the incentive to undertake what we as economists call price discovery. In other words, it doesn't really matter if what I'm buying is good or bad, as long as I can buy it cheap. And the reason for that, and by cheap I mean in frictional costs like brokerage, funds management fees. And the reason, of course, is that if I have to be index aware anyway, I'm required by law to mimic the index, at least for the vast majority of my investments. Why should I spend lots of money trying to make small tweaks to that when I cannot extract a fee for doing so? I might as well just go fully index aware, track the index completely, not engage any costs in trying to understand what I'm doing, keep my costs down and maximize my profit. And so as of June 2025, MySuper products doing this low-fee, fixed low-fee, index-aware option account for $1.2 trillion of invested funds, which is just over a quarter of our total Australian superannuation holdings. It's a big number. Second piece of legislation or theme that really affects Australian exceptionalism in the case of passive investing in AI was the Hayne Royal Commission, which ran between 2017 and 2019. And in addition to its review of banking, as you'll remember, the Hayne Royal Commission was looking into fee for no service and other poor practices in the banking sector. The Hayne Royal Commission was particularly scathing about our financial advisors and financial advice, who at that stage, or today as well, represent approximately 1.2 trillion of funds under management. And as a result of the Hayne Royal Commission, a number of recommendations came out which led to three main effects, including reporting requirements and personal liability. And those three things were, firstly, that the number of financial advisors has materially declined. You know, if you increase liability and cap fees, you make the industry less attractive. It's as simple as that. So we used to have around 18,000 financial advisors in this country, or 20-something thousand at one point actually at its peak, and we're now down to a much, much smaller number, only 15,000 now from 27,000 at the peak. And secondly, those financial advisors have logically, for reasons of self-interest that I can entirely understand, said, why should I continue to provide investment advice, which carries huge personal risk and liability and got me in lots of trouble in the Hayne Royal Commission, and instead, why don't I focus on planning, insurance and structuring, which are those categories? And in fact, according to recent surveys, the Australian Financial Advisor Landscape Report 2025 of financial advisors in this country, 76% of advisor revenue now comes from services other than asset-based fees. In other words, providing information to their clients that has nothing to do with their investment returns. And where they do provide investment advice, the tendency has become to outsource it. Because if I make the decision as the financial advisor, I now carry material personal liability. Whereas if I can outsource that, I can risk transfer. I can risk transfer either to, for example, an index fund. I'm not picking investments. I'm just saying, you know, based on your risk profile, you should have some exposure to Australian equities, the ASX 200, and some exposure to the US, say the NASDAQ. And now I'm not at risk. I'm not picking anything. Or an asset consultant. You know, you should pick things, but it's not going to be me who picks them. I'm going to outsource them to someone else who does the picking for me. And so now, when you look at that sector, that $1.2 trillion of FUM inside financial planning and financial advising, only 59% is actively managed with or without a consultant. The other 41% is in index funds. And of that 59%, 40% of them, so almost half, intend to decrease their active allocation going forward as a risk transfer. So in other words, financial advisors and financial planners are exiting the active management space rapidly. They are quickly handing over the decision of where our money sits as investors in Australia to third parties, whether that's a passive index or an asset allocator, because the liabilities got too big. And then the third main point of Australian exceptionalism followed the Hayne Royal Commission in 21 to 23 under the Your Future, Your Super legislation, which was instituted by the Morrison government, which included a superannuation performance test. Now, the first of the superannuation performance tests was applied to MySuper in 2021 and was since in 2023 expanded to all superannuation funds other than SMSF. So anyone that's in a super fund other than your own SMSF falls under this test. And that represents $2.9 trillion of FUM. That's a big number. It's the vast majority of money in this country. And what that test does is it ranks the performance of the fund against an individualised benchmark, so not some standard benchmark, but a benchmark specific to that fund, based simply on asset class allocation as set by the Australian Prudential Regulating Authority, APRA. And importantly, this is the key bit, funds are not assessed on their absolute return. In other words, they're not assessed based on whether they made money for their clients, or return relative to their peers. Did they make more money than their competitors? But simply against what APRA thinks they would have earned based entirely on asset class allocation. And of course, to do that, APRA picks a benchmark, which are the major indices. And that benchmark will exclude fees while fund performance includes them, which APRA thinks minimises fee drag, reduces the opportunity for the fund to charge a fee. And the test is punitive. If you miss the benchmark by as little as 0.5% in a year, you're required to send a public apology to all your investors and you're issued a formal warning from APRA. And if you miss it 2 years in a row, your fund is closed. APRA shuts you down. Which effectively, when you talk about personal liability for financial advisors, means an even greater form of capital killing liability being introduced to fund managers that miss the index after fees in the short term. Effectively, what this has meant is that any fund manager who wants to hold anything other than the index in superannuation takes the massive risk that all they've got to do is get it wrong by 0.5% after fees, and fees, remember, will be a portion of that 0.5% anyway in any year, and they lose their business. As you can imagine, as Charlie Munger said, show me the incentive, I'll show you the outcome. This has meant that the vast majority of superannuation fund trustees have started to follow the index. Why? Well, if I got a better return than the index, I'm not rewarded anyway. And if I get a worse return than the index, I'm out of a job. So why would I put any effort into trying to hold anything other than the index? So why does all of this matter other than it being a series of perverse incentives, first driven by passive investing in AI and quantitative models, and then exacerbated by Australian exceptionism? Well, there's two things I want to call out. Firstly, the Grossman-Stiglitz paradox, which is a very famous economic paradox that came out in 1980 in a famous paper. And what they posited, Grossman and Stiglitz, was that if markets were perfectly efficient, in other words, all prices instantly and fully reflected all information, which is sort of the foundation of modern economic theory, right? That the market is efficient, that the market naturally collates all information and finds the correct price for that asset, the invisible hand of the market. Then no one would have any incentive to gather information if there was a cost to do so, because they couldn't earn returns from it. But paradoxically, if no one's out there gathering information, then the market cannot be efficient because prices won't reflect fundamentals. So I just want you to sort of dwell on that for a second. What it says is, it says that if markets were efficient, there would be no benefit in doing research. But of course, the underlying argument of markets being efficient is that people are out there doing research to arbitrage any mispricing. So in other words, I know the asset is overvalued, so I will short it, or I know the asset is undervalued, so I'll buy it. In order for me to know that, I've had to spend money and time to gather that information. But paradoxically, if the market's efficient, gathering that information gives me no benefit, so I'll stop trying. In other words, if speed becomes more important, or tracking an index becomes more important than doing research, then by definition, the market cannot be efficient, even though the reason that index funds and AI exists is on the basis that markets are efficient. It's a paradox, right? It's like the old time traveler paradox. What would happen if you went back in time and shot your grandfather before your parents were born? Well, if your parents weren't born, you couldn't have been born, so you couldn't go back in time to shoot your grandfather. This is a fascinating paradox about time travel, and obviously many philosophers have been employed for many years opining on it. It gets even better because Jack Bogle, the founder of Vanguard, which is the world's first and largest passive investment company, and in many ways credited as the founder of index or passive investing, in 2017, at the Berkshire Hathaway AGM, or just after the Berkshire Hathaway AGM, where he was there giving an interview, said that if every body index, the only word you could use is chaos, catastrophe, but it's not going to happen. And when he was asked by what he means by it's not going to happen, he said, well, every time someone indexes, the market gets a little less efficient. But if it gets less efficient, some managers can win by more, and some managers will lose by more. This is the equation. The less efficient it is, the more there's a benefit and a risk in playing in the space. So I'm not concerned about it. It's going to take a long, long time for indexing to get anywhere near 50%, and things will change a lot in other ways by then. And really what he was saying is indexing has no chance in 2017 of ever becoming the majority of the market. And anyway, even if it became the majority of the market and you'd have total chaos and catastrophe, that just means you get some really big winners and really big losers. Which of course is the opposite of the concept of passive investing. You should have everyone getting stable, similar returns, right? But that's again part of this paradox. So if Jack Bogle's out there saying 50% of the market would cause chaos and catastrophe, but it wasn't going to happen, and the Grossman-Stiglitz paradox implies that even a reasonable amount of the market creates major problems for price discovery and efficiency, then we should probably ask, how close are we in Australia? And it turns out, if you do that, I've put this table up here, this is my research, it turns out that of the $6.8 trillion of Australian money invested in all asset classes, by my calculations, only a maximum of 28%, or $1.9 trillion, is now actively managed. We've blown way past 50%. And to put in context, that 1.9 trillion, which includes property and bonds and fixed income and deposits and any other asset class you can think of, cryptocurrency or others, is compared to an ASX with a current combined market cap of $2.9 trillion. It is not active money that is moving the ASX anymore. So from that point of view, I'm a nerd. I always like to ask, if a thesis is potentially true and provable, what might it mean and how can you test it? Because if you know what it means and you know you can test it, you can end up with a really big advantage. And that advantage can come in one of two forms, either avoiding a major mistake. Buffett's rule 1 is don't lose money, and Buffett's rule 2 is never forget rule 1. Or number 2, an opportunity to get a major edge in your own investing such that you can get much greater returns than the index over time. So there's 4 hypotheses. You may have others, and I'd love if you come up with them for you to post them in the chat or in the Q&A, and we can talk about them. But the 4 hypotheses that come to my mind are, firstly, number 1, if the market is less efficient and being driven more by chaos and catastrophe, less by thinking, then we would observe greater short-term volatility around earnings announcements, because simply the market would experience more surprises because less people are looking at what's going on. More people are followed on sentiment, or they're holding the index, or it's an AI scraping the information. Now remember, when the AI finds out about an earnings announcement, by definition, it's the first time it's heard of it. The AI hasn't been thinking about what could occur. The AI is dealing with what has happened. It's just trying to deal with that faster. And hypothesis 2, we could therefore expect larger bubbles and deeper market crashes, or think of it as short-term market bubbles and crashes with individual stocks rather than necessarily the market as a whole. And that's simply because prices will deviate further from intrinsic value if less people are spending effort to establish what intrinsic value is, or if they can establish what intrinsic value is, if they can't deploy enough capital to counteract the weight of passive money, the same effect will happen. Effectively throwing cups of water into the ocean doesn't change the size of the ocean, right? Same kind of thing here. If you're trying to trade against the passive money to correct a mispricing, you have to have enough money to move the market. And that amount of money has to be, by definition, equal to or greater than the amount of money on the other side. If you've got a cup and they've got a swimming pool, you can't move the market. You need to have 2 swimming pools or 2 cups. Hypothesis 3, there'll be more scams and smoke and mirrors, because simply it's easier to fool people about what's going on when their attention is diverted. If most people are focused on what's happening to the index, or what's happening to the group as a whole, or what's happening to the words that are being used in an index, company's announcement or fixed income announcement, then it's much, much easier to hide dodgy things in the underlying company. Ponzi schemes, smoke and mirrors, dodgy activity by managers, because people's attention is diverted. And Terry Pratchett, the author, has a line that I love, which it says that at the heart of any scam or fiddle is the idea that you need to keep the punter uncertain, or if he is certain, make him certain of the wrong thing. So either uncertain, I'm not doing any thinking, that would be passive index investing as an example, or certain of the wrong thing. I'm focused on sentiment. I'm focused on whether something's going into the index and going to get a bump. I'm focused on what language was used by the board around the earnings announcement. Not have they taken money out of the company. Not have they sold any of their actual products or services. Not have they got paid for what they've sold. Or is it all smoke and mirrors? Because that's longer term thinking. There's no speed advantage in that. And hence AI quant passive investing doesn't take it into account. Hypothesis, lastly, which is perhaps the longest bow that I'm drawing here, but I think is relevant, is that we should see rising wealth inequality. And what I mean by that is the herd will get poorer faster because they will be chasing themselves in high prices into the wrong assets and getting out of undervalued things at low prices with that momentum and activity and speed. And the few good active investors will end up with much, much bigger prizes in the long term, simply because not buying into that mistake ends up paying off a lot more. If you think about it, if the market is very efficient and you get an edge historically, that may have been worth a few percent. But if the market is going to swing 10 or 20% on stupidity, then that edge suddenly overnight became not the difference between getting rich slowly, but getting rich to orders of magnitude in a much faster period of time. And that's really where I think for us, we can spend our time thinking. So I want to test the first 3 hypotheses. a little bit of the fourth. And then I want to talk with you guys about what that might mean and how we can take advantage. Because otherwise, all I'm doing is painting a pretty bleak picture of the future. And that's not what I want to do. I'm actually very much always an optimist. I don't think the future is bleak. I think this is going to be the best time to be an active investor in history. And I'm seeing that already in my own results, but I think we can talk about it as a general theme. And I think it's the best time to be an active investor in history. And I've used this analogy at Teaminvest meetings and on TV a few times, because I think I'm now playing poker against a bunch of people at the casino who are all 6 drinks deep. And that's the old joke at poker. If you sit down at a table and you don't know who the patsy is, it's probably you. And I think a hell of a lot of these index funds and algorithmic traders and AI-driven strategies are taking in a lot of money right now, and they're betting it all on the table, and smart active investors are going to clean all of that up in spades. Which is lovely if you're one of the smart active investors, awful if it's your retirement savings caught up with one of those drunk people betting no matter what the hand says. So, hypothesis 1, greater short-term volatility around earnings announcements. In other words, more surprises as less people are looking. This is a chart that was put together by Jason Tay, who's a portfolio manager at Climb Investment Management back in September. And what it does is it shows the intraday volatility on the days of earning announcements for the ASX for the last 4 years. And what it shows, as you can see, is there is a clear trend, an increasing trend, that as passive investing has risen, as AI trading has risen, so too has intraday volatility. It's in fact almost doubled. And in fact, even more so than that lovely graph, but more convincing because it's been more rigorously tested, is a recent paper by Salmon in the Journal of Management Science, and I'm obviously feel free to go look it up. I've put the reference down below, but states very much clearly that passive ownership negatively affects the degree to which stock prices anticipate earnings announcements, and that the rise in passive ownership over the last 30 years has caused the amount of information incorporated into prices ahead of earnings announcements to decline by approximately 1/4 of its whole sample mean and 1/6 of its whole sample standard deviation. So for those who are less nerdy than me and want to have that translated, what it really means is that as passive ownership has risen over the last 30 years, so too has the market become more inefficient to the point where now it is 25% less efficient than it was 30 years ago, and that standard deviation has increased by 15 to 16%, which is, in finance terms, orders of magnitude beyond statistically significant. Normally we're talking about a 1% change in standard deviation or a 1 or 2% shift in the mean. Here we're talking high double-digit shifts. And as I said before, when you look at it from an ASX perspective, Salmon was looking at all global markets, you can see that ASX intraday volatility around reporting has risen approximately 40% since February 22 alone. And I think most of us anecdotally would have seen that in this earnings season. I mean, how many companies did you see or read about in the press who made an announcement and their share price moved not 5% or 7% or 4%, but 10, 20, 30%. I mean, Temple & Webster yesterday was a 33% decline on no real new information. Drone Shield, because in their case, management sold, but at the same time as earnings announcement, 30% over 2 days. CSL, 30% over 2 days. CBA, 15% over 2 days. These are huge volumes of money. These aren't small companies. These are some of the largest companies in the country. It's billions of dollars being moved in theory value, wiped out or gained, depending on which side of the swing that was, because people are being surprised. Think about that. You're entrusting your money as a low-income earner, hopefully not as a high-income earner, but as a low-income earner to a super fund that follows an index, and massive percentages, 30%, 20% of your money is evaporating because no one was bothering to look at what they owned. And you hope that'll come back over time, sure, but that's a dangerous game to be playing. So that leads into hypothesis 2, which is bigger bubbles and crashes. Because if we already know, and we do already know, that bigger volatility ends up causing bigger bubbles and crashes, we can also use some other research done by Chung and Coleman, and Stephen Chung from University of Sydney, around the frequency and size of bubbles when you introduce fund rankings. So if you think about it from an economics theory standpoint, we look at the market and we say that each fund manager is charged with one thing and one thing only, and that is maximising the returns for their fund. That is the rational thing for them to do. And that assumes that the only way a fund manager makes money is by making money off the assets they're investing or trading, and that a portion of that gain comes back to them. So it's rational for them to want to maximise the net return to investors. Of course, that's a really lovely construct, but we know that's not the case in reality. I mean, number one, you've got MySuper out here saying fixed low fee. Doesn't matter what we make, you can charge the same amount. So that's immediately proving that that model doesn't work. And then you've got all sorts of weird and wacky structures, as well as things like the fact that we as humans like to be part of the crowd. So if you assume that, for example, as humans, we like to be with winners, you know, the idea that we like to back people who are doing well, and you introduce a question of what happens once that occurs, that if someone is performing well, more money flows to them, and someone's performing badly, money flows out of them on short-term performance. Turns out there's a bunch of really cool experiments you can do in a lab. We did a bunch in 2014, and what we found was that markets started to bubble materially as soon as relative performance was included. As soon as you started to show participants that they got rewarded based on how they ranked relative to their peers, so number one trader versus, you know, wooden spoon trader, even if they didn't get money for that, just showing them their ranking changed their behavior. If you included money for that, it changed their behavior even further. Secondly, we found that bubbles were significantly more pronounced in markets with unexpected or uncertain payoffs. In other words, when there was any level of uncertainty about the future. So you do that by giving people a fixed instrument versus a variable instrument. But we found that bubbles occurred in both types of markets as soon as you inserted relative performance, and the more uncertain the outcomes were, the bigger the bubble and the crash, which kind of makes common sense. Most scarily, though, we found that even when the intrinsic value of the asset was known, so we said in 10 minutes' time, anyone who holds this asset will get $100. So it has a fixed value. And we told the traders that, and we showed them on their screen. It's $100 in, counting down. Markets still bubbled and crashed the second that relative performance was included. They didn't crash without relative performance and didn't bubble without relative performance. And most scarily, on top of that, if you can think that it could be even more scary than that, contrary to accepted wisdom, the effects of those bubbles and crashes increased with experience. In other words, instead of learning from their mistake, you know, this asset was worth $100 at the end and I bought it for 120, so I lost money. In fact, all it did was encourage them to do more of it the more times they won and lost. In other words, what the traders learnt in the experiment was not I'm losing money, but was that my ranking matters. I need to be first. Now, we did that in an experimental market. Imagine if the question had been, if you're first, you make that money, and if you're last, you lose your job or you go to jail. What would the incentive have been then? And when we actually asked participants why were they doing it, the comments came back like this. I knew the asset was overvalued. Others were buying it, and I didn't want to come last. I didn't want to be without it. And similarly, when it was crashing, I knew it was undervalued, but I didn't want to be the one riding it all the way down. Starting to sound like fund managers and financial advisors. So, can we test it? Because we're not in a lab. And I can't test if we're in a real world bubble. I can have a view that I'm in a real world bubble or not, but I can never really test it because you can only prove a bubble in hindsight. You know, you only know the bubble existed after it pops or deflates. But what we can do instead is test for what a subject called price distortion. So what price distortion is looking about two assets that in theory should be valued the same and seeing is one valued differently to the other. That's a form of price distortion. Efficient markets theory says there should be an arbitrage to equate those two assets to be of equal value. And so what we can do is we can test both if passive investing causes a price distortion in an ETF, and we can also test it whether there exists what's called an index premium. So Duffy and all sometime this year showed that index inclusion in an ETF, so the idea of a company exists, put it into an ETF. The second you put it into an ETF, it creates a share price premium, even when the same participants were able to arbitrage that away by selling short. In other words, simply being included in an index or an ETF creates a premium. It's completely irrational, Like being in an index should have no effect on the value of the underlying asset. But because of basically human behaviour, more so than anything else, as well as weight of money that flows in and out of these indexes, immediately upon being included in an ETF or included in an index, a premium starts to generate. And we can also test to see if there's an index premium in, for example, the Australian market, which I've done here on the right in a chart, which really says, look at the average PE of companies outside the index, and then look at them by each level of index. So, for example, everyone is company on the ASX. 500 of those are in the All Ords. 300 of those are in both the ASX 300 and the All Ords. 200 are in the 200, the 300, and the All Ords. And 100 are in the 100, 200, 300, and All Ords. In other words, each time you move up that chain, all you're doing is inserting an extra index. Because they're still in the index below, they're now in more indexes. So what you would not want to see is A, an index premium existing. That would tell you the market's inefficient. But even worse, what you really wouldn't want to see is that the index premium gets bigger with each extra index that's being included, because that tells you it's the indexes that are having the effect on the premium, not simply that it's just a good company and happens to therefore be worth more. And of course, when you look at it in the ASX, that's exactly what you see. You see an 11% premium for being in the All Ords, a 23% premium for being in the 300, a 26% premium for being in the 200, and a 40% premium today on PE ratios for being in the 100, which again is proof of this idea that relative ranking is skewing prices beyond fundamentals. So hypothesis 3 is more scams. This idea that nothing attracts sharks faster than dumb money. So if a large amount of money is being invested based on dumb known rules, then theoretically those with less ethics are able to try and take advantage. It's that idea, if you know the bank is storing a lot of gold, there's an incentive for someone to try and rob it. If you don't know where the gold is, there's no point trying to go after it, right? So if we're out there telling dodgy people that there's a huge amount of money that's going to invest based on these set rules, then that's an incentive for someone to chase a mimicking of those rules or take the other side of the trade to take advantage of it. I'll give you a couple of examples of what I would consider are potential scams. Can't know if they're scams till after the event. They just sound illogical for any other reason. For example, in the United States, there are now a very large number of single stock ETFs. So what's a single stock ETF? I can buy a fund that owns one stock, the same stock that I could buy directly, for which I will pay that fund manager a premium for owning exactly the same thing I could own myself. There is no rational reason why you would ever do that, unless you think that by being in an ETF, you get a premium. I can buy the stock directly, or I can buy the stock in an ETF, and buying it in the ETF costs more money to do. I should, in theory, never touch the ETF. So if I'm not buying the stock directly, I'm buying it in the ETF, it means I'm assuming that there is a premium simply for being in the ETF. That's a scam, isn't it? In the sense of not dodgy behavior by the fund manager, but it's a scam in the sense of there is entirely smoke and mirrors around value creation here. There's no value that's been created. It's a premium created by a rule, a dumb rule. Secondly, we would expect to find rising fraud in something like superannuation, because if you know the rules, you know that no one is going to be doing any form of price discovery, that people aren't going to be looking at the underlying assets, then it's easier to put dodgy things in, pretending that they're okay. And is that perhaps what happened with Shield and First Guardian? People rely upon these ephemeral gatekeepers. It's index aware, it's fixed low fee, it's superannuation, it's protected, it's got to follow the index to enable people to run Ponzi schemes and market. And we see that also in AFCA complaints. That's the Australian Financial Complaints Authority. Complaints are rising. We had an 18% increase last year in complaints about investment and advice, and a 95% increase in relation to SMSF investing. And I think what you'd start to see as well in relation to dumb money and scams is investment bankers. I'm a former investment banker. We're not exactly known for not wanting to play the market to extract the maximum for us, no matter the social cost. I don't think I've ever met an investment banker who people say, what a lovely person. He sacrificed his own wealth for the benefit of society. Investment bankers might now be starting to encourage companies to game index inclusion. Play around with your register, issue new stock, sell down from founders. Do anything you can to get into a better index, because when you get into that index, you'll see a price bump, and that's a value bump. So do something to get into an index, and then it doesn't matter if you sell your shares. And I don't include them here, but Drone Shield's potentially one of those. Guzman and Gomez, potentially Promedicus, Cigna Healthcare, James Hardie. All of these went through, if you look through the last few years, big changes that they argued was on the basis of wanting to get index inclusion, and almost straight after getting that index inclusion had some form of sell down from the promoter, whether that investment bank or the founders or the board and management. And then lastly, you might see companies starting to try to pick the market they want to list in based on index requirements. For example, if you are a technology stock, you may want to go in an index that has easier rules to get included as a technology stock. Pick the market in order to fit the index rather than run your business to maximize where your shareholders are. And then lastly, hypothesis 4, I think the hurdle gets poorer faster, and those who don't fall for the mistake will be the beneficiaries. Because if passive money is flowing into the bubble, each new dollar by definition becomes riskier and has more to lose. Each dollar is invested at a larger gap from intrinsic value than the one before. And if money flows out in a crash, when a share price drops, whether that's a crash of the index or just a crash of a company, then of course anyone selling into that crash locks in a loss at a bigger discount. And if volume drives daily price, it can become self-fulfilling like a run on the bank really quickly. Price drops, passive funds go, price is dropping, I need to hold less, they sell. AI says, look, it's dropping, that must be bad, quick get out, which of course means more volume in the sell column, further drop. Drop, 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 until eventually the weight of money on the other side is large enough to stop it. And I think that's what's been driving a lot of these really big double-digit drops. It's not the announcement the companies make, it's how the quants and AI and passive investors react to that announcement quickly. Because remember, speed is everything to them. They don't want to be waiting 2 days to think about it. They want to be trading right away. That's their edge. So if they all go to trade right away, that doesn't give enough time for buyers to get on the other side of the investment, does it? So it's going to be a massive drop quickly, running down the depth of the register. And in 2013, Pfeffer, Danziger, and Shoney had a look at the effects of the 2009 US recession. And they actually found, and that's obviously the GFC as we call it, they found that relative to 2003, the wealth of the top quartile was unaffected 2 years later. They'd rode the drop out and in fact bought assets at discounted prices. The wealth of the upper middle class declined an average of 14%. They had to sell some assets in the period, but they were able to mostly wear it out. The lower middle class declined 45%, and the lowest quartile was effectively wiped out, an 85% decline. Now, I don't know about you, but most people cannot survive an 85% decline in terms of ever rebuilding your wealth. And I would posit that if passive investing has been aimed, and AI investing has been aimed primarily at those who don't have an ability to choose for themselves, and who want low fee speed, then they are probably overrepresented in that bottom, lower, and upper middle class quartiles rather than the top quartile, which I would think creates a great problem for society, but perversely gives all of us as active investors a massive edge. So what is that edge? Because I've spent a lot of time talking about the negatives. What's the advantage? Well, if you're someone like us at Teaminvest who looks at earnings and underlying companies and doesn't make decisions based on price, sentiment, dumb rules, momentum, or index inclusion, then you are going to get bigger and bigger bargains than you've ever got before. Bradman famously said, you can't get caught if you keep the ball on the ground. If we don't buy into the bubble and sell out in the crash, we will be the net beneficiary. If a company we like drops 30% on nothing other than index rules, well, that could be a 30% better buying opportunity. It's a bargain. It's just gone on special. And similarly, if a company we like a little bit and we own doubles or triples in price because of silly things like index inclusion or AI, well, isn't that the perfect opportunity to sell out and lock in a wonderful gain that used to normally take, many years to achieve? I mean, we talk about Teaminvest wanting to get 15 to 20% per annum, which means 4 to 6 times our money in 10 years. Well, if the market offers you 4 to 6 times your money in 2, why wait the other 8? Gives you an ability to take the gain now while the market is irrational. Secondly, all of us are at a stage of life and wealth where thankfully, and by being on this call or watching this, I assume you are too, you don't have to follow an index, an ETF, or a performance test. You are not an APRA-regulated super fund. You're not counted by the performance test. You're not a 18-year-old working at Macca's having to put your money into my super. So you can choose, unlike them, to sit out any irrational bubble or panic-driven drop rather than having to buy high and sell low or get caught up in that momentum. Thirdly, as thinking humans, as opposed to unthinking pieces of technology or rules, you can use skepticism to be your friend. Try to avoid the dogs, not pick unicorns. Don't look at whether a company's share price is rising or because the AFR ran a puff piece or because of potential future earnings, which are all the things that the AI model is feeding in. The AI is scraping the AFR. The indexes are looking at rising share prices because indexes are market cap weighted. Look at other things, the underlying assets. And you don't have to sell just because in an inverse case, the share price is falling off the back of a rumour or an article in the Australian. And then I would hope most of you don't have to pay off any debts if the market does crash or a certain company crashes. For example, you're not trading with margin loans, and therefore a fall is not going to wipe you out like that bottom quartile. It's actually going to give you a buying opportunity. And if you're sitting on cash, then that's an even bigger buying opportunity. And then lastly, of course, our own software at Teaminvest, and many of you are Teaminvest members, but if you're not, feel free to contact us and find out more, Conscious Investor. We're already looking at reversion to the mean and avoiding companies with capital killing risks. So we're less likely to be caught up in the mania and burnt in the crash. And lastly, I would leave you with the lovely quote of Baron Rothschild at the time of the French Revolution: when there's blood in the streets, it's time to buy property. So I think right now, when everyone's euphoric about quantitative investing, passive investing and AI, it may not be the time to buy property, whether that's physical property or stocks. But I think that's going to change very soon. And I think we've started to see that already with certain companies dropping 20 and 30% in record time off the back of the volatility and the silliness being caused by passive dumb rules and the following of dumb rules.
Thank you for joining us this year on Teaminvest Wealth Builders podcast. This was our launch year, and we hope that you have enjoyed listening to it and learning from it as much as we have enjoyed bringing it to you. We want to wish you and your family a very happy festive season, and we will see you all again in February 2026. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.